Hello everyone, this is Angwan from AllQuant. Now, have you heard of the word or the term all-weather investing strategy? These are strategies that were available in the past only to high net worth individuals. But today, right, the wider public also have access to these strategies either through exchange traded funds or maybe through their advisors. Okay, but to trace back the roots, right, all-weather is actually a term coined, popularized by Ray Dalio, right, who is the founder of Bridgewater Associates and is one of the largest hedge fund around in the world today. Now, he launched a fund, right, using a concept called risk parity back in 1996, and then he named that fund the all-weather fund. All right, but it doesn't mean the fund is invincible and will never run into a bad patch. It doesn't work that way. But there are good reasons, right, behind the name itself. Now, the main idea behind risk parity is to hold a balanced portfolio comprising of different assets such as stocks, bonds, and commodities, and whatever, right? And these assets are then sized up equally by risk. All right, I know by capital, but it's usually how people would do it. So why would this work? All right, just ask yourself this question. Can you predict the market? Now, if your answer is a yes, okay, you can stop watching the video now, all right? But if it is a no, right, then look at it. It makes perfect sense to hold a balanced portfolio and then let the assets take care of themselves. Right? Because different assets thrive under different market regimes. For example, in an economic downturn, stocks is going to fall. But bonds, right, will usually rise as investors switches out of their risky assets and then park their funds into safe havens. So the intention here, right, is to have a balanced mix of assets in a portfolio so that it is robust enough to weather through different types of market regimes. But things turn out quite ugly for all-weather funds this year. While the fundamental premise still looks sound, the investment weather this year is unfortunately not one of those weathers that the fund is prepared for. So it turns out to be a disaster. Why? Right, because there is nowhere to hide. Right, look at what happened. Stocks are down, bonds are down, gold is down, even inflation-linked bonds are down, and REITs are also down. So the only bastions of safety still standing today are your commodities and the US dollar. So how does all these actually translate into performance for all-weather funds? You can actually describe it in one word: bad, right? They're all in the red this year. Now, bonds, which was badly hit in particular, is the core component in all-weather funds. And on top of that, these funds usually use some form of leverage, meaning they actually borrow money on top of what they have to invest. Okay, and as a result of that, the losses can run rather deep. So this is the RPAR, right, which is a risk parity ETF, and it is down like 27% as of end of October. And it runs at about 1.2 times leverage, which is not a lot of leverage, by the way, for risk parity funds. And this is UPAR, which is a small aggressive sibling running at 1.7 times leverage. And of course, it is down even more for the year at 35.5%. And even the pioneer of them all, Ray Dalio's all-weather fund, is also down 32% as of the end of September, right? So it's fun. Do things a little bit differently in the sense that he adjusts the leverage used from time to time by targeting a specific risk level for his portfolio. And even though I don't know the details, but given how the overall market risks have risen in this climate, I would expect his fund to be operating at a much lower leverage than usual. And even then, the fund still took a fairly big hit. So what is causing all these assets to crumble? Now, as we can see from here, diversification, which is a centerpiece around all-weather funds, virtually breaks down this year, right? Every asset becomes correlated and they start going down, right, together with each other. And what is causing them to do this? There are two main causes here. First is inflation. Now, inflation has been ramping up since 2021, and this year headline inflation hits a high of 8.9% before coming off down to the low 8s. Yes, it has come down, but it is still too high, right? And inflation can be deadly. So if you want an analogy, you can think of like inflation, right? Like a type of cancer. You don't feel its effects immediately, but if you leave it unchecked, it will spread and it will lead to very serious problems down the road. It will erode the value of everything you own and make everyone worse off, right? So something has to be done on it. And that something that needs to be done is actually the second cause. Rate hikes from US Federal Reserve and central banks worldwide. Now, maintaining price stability and keeping inflation under control is the top priority for the US Federal Reserve. And they only have one effective tool they can use to fight inflation, and that is to hike the Fed funds rate. Now, Fed funds rate is an overnight rate that banks charge each other to borrow or lend their excess reserves. Okay, but even though it's an overnight rate, they will filter into the markets and put upward pressure on interest rates across board be it short-term, medium-term, or long-term rates. So you can see all these rate hikes as chemotherapy treatment for the inflation. And why do I say it's like chemotherapy? Well, because it is a very blunt tool. It simply hammers everything, whether it is good or bad. Now, it raises the business costs, it raises your mortgage loans, it raises your credit card loans, it raises your personal loans or whatever, right? And it dampens demand. But that is precisely what is needed to bring inflation down. So does that mean that all-weather fund and the risk parity concepts are no longer relevant going forward? Now, holy grails don't exist. You got to understand that all strategies have their own strengths and their weaknesses, and they all go through their fair share of ups and downs. Now, if being down means they're no longer relevant, then there will be no working strategies today. All right. So just like trend following funds, right? They trail far behind others in terms of performance for many, many years, but they came back this year very strongly with a vengeance, right? And value investing, which is a hot favorite among many people, they too can be out of favor for a long time, and they can suffer really huge drops in bad times also. But does that mean that we should throw value investing out of the window? No, right? Because they're still very much relevant. Why? Because the fundamental premise of the concept remain intact. And the same goes for all-weather funds and risk parity, right? Because things like diversification, equal resizing across different assets, and building a balanced portfolio, that is still very much a sensible and practical approach, at least as far as I'm concerned. Okay, and if you look back in history, this year is also one of those very rare years where both stocks and bonds fell in tandem. In the past 100 years, there are only 4 such occurrences, including this year. Although this is the worst out of the 4 years. And why is that the case? Because bond yields are at a record low before this thing hits. So in comparison with the past, the risk reward from bonds today look a lot less attractive. Interestingly, Ray Dalio, who founded the all-weather fund himself, actually made a comment early in 2022 saying that this printing of money and buying of debt assets has driven interest rates so low that cash and bonds are stupid to own, right? And he's talking about nominal bonds or non-inflation linked bonds. Now, if we take it at face value, he is not wrong, right? Because interest rates were at an all-time low before the rate hike begins. So the risk of bonds do indeed outweigh the rewards. But he also said this, okay, I think one should consider minimizing one's ownership of cash and bonds in dollars or euros and yen, right? And putting funds into a highly diversified portfolio of assets, including stocks, inflation hedge assets, especially in countries with healthy finances and well-educated and civil populations that have internal order. And he also said this, I don't see any sustained period in which the government would likely allow cash returns to be better than the returns of a well-diversified non-cash portfolio, such as an all-weather portfolio, yet to the level of risk you're comfortable with, because that would cause terrible problems. So if you look at it in totality, he's still very much a proponent of the all-weather approach. And while I do not know if he reduces the size of the nominal bonds in his all-weather fund, but he is still very likely invested in them. All right? And if you're not aware, all-weather fund isn't the only fund that Bridgewater runs. Okay, Bridgewater also runs another fund called the Pure Alpha Fund. And people often mix the two up, right? And talk like they're the same, but they're actually totally different funds. So the Pure Alpha Fund is a macro fund, and it runs a totally different strategy from the all-weather fund itself. So the Pure Alpha Fund trades based on the best convictions. And probably like many other macro hedge funds out there, they have been long on commodities, short on bonds, and maybe putting on bets on the yield curve inverting on the backdrop of rising inflation and central bank hikes. Okay, so when Ray Dalio makes a comment like this, he could well also be coming from his macro view perspective. So that brings us to the next question. When would the all-weather strategy or all-weather funds recover? Now, if you're looking for an answer on the precise time, then don't bother, okay? Because no one will know the answer to that. Okay, but what we do know is what kind of scenarios can set it back on a positive path. And a lot is going to hinge on how bonds perform because it is a critical part of the all-weather portfolio, right? The first scenario could be the Fed pivots and then goes slow or stop the rate hikes entirely. Now, other central banks are already caving into pressures, but in my personal opinion, the likelihood is not strong because US, unlike other countries, are in a much better position. Consumer spending is still healthy, hiring is still strong, wages are still growing, corporate earnings still beating estimates. GDP has slowed, but it still delivered, right, a positive print in the third quarter based on the first estimate. And most important of all, right, inflation is still high even though it has come off, right? And already being late, right, to respond to inflation, Fed's credibility had already taken a big hit. So chances are they will prioritize fighting inflation, even if it means pushing the economy into a recession. Okay, and there is a good chance they might, right, given their track record. First, they're always late. Then they overreact until something breaks, right? Kind of rhymes. Okay, and this brings me to the second scenario, the economy sinking into recession. Okay, and this is where the economy contracts, unemployment rises, and the demand cools off rapidly. And this is likely going to put inflation back. And with bond yields being much higher today, so we're almost nearing 2008 levels, this will give Fed enough room and reason to stop and reverse course. But of course, the market will already have anticipated this ahead of time if this happens, and then they will move out of risky assets such as stocks, which is likely going to be hit even more during the scenario, and then it will switch back right into bonds again. All right. Then the third scenario is a soft landing scenario with inflation miraculously coming down. Okay, maybe Fed managed to balance everything out nicely. Maybe China restart its full engine. Maybe Russia, Ukraine ends their conflict. And maybe there is a huge influx of qualified job seekers coming into the market and resolving whatever imbalances you might have. All right, but as long as inflation comes down, this can take Fed's feet off the pedal, and the pressure will be off the bonds. But for folks who are already running their all-weather portfolios or strategies, what can you do, right? Now, one thing you can consider doing is to lower your leverage. Now, there are various ways to do it, but one common approach is to target a specific risk level for your portfolio. And during volatile times like this, where risk across the market all spike up a lot, you will reduce your leverage in order to bring the portfolio's risk down to meet your target. Then, second, you can diversify across different strategies. Now, you can diversify in many different ways. So diversification need not just be constrained to different securities or different assets, but it can also be across different strategies. And there are many other strategies out there, right? So if you have a good mix of strategies, but it can actually make your overall investment portfolio to be more robust. All right. But having said that, all this only makes sense if you believe that the premise still works. And that will be the most important, right? Because this is what is going to support your faith on the strategy. But if your faith is no longer there, then there is one more option, and that is to just exit, right, entirely and pursue some other strategies or approaches. All right, so this is all I have for this video. If you like it, do remember to give us a like and subscribe to our channel. All right, and if you do want to know what we do and offer at AllQuant, you can visit our website. So the link is in the YouTube description below. Right. Finally, all the best to your trading and investing, and I'll see you soon.